Hello everybody, my name is Lush Eisner and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I get asked very often about how to start investing, and so I thought I would do a video. It's as simple or as complex as you would want it to be. Make sure you start early and as soon as possible. First, start with an investing thesis. It should be written with measurable parameters and compare all investments to this to make sure you are on track and you own assets that fit the investment thesis and you're not just buying random assets. There's two types of thesis. The first is top down. It's an investing thesis that ties everything together. For example, invest in developing countries with a young population that grows fastest as people are being pulled out of poverty. Or the world will need clean water and food more than anything in the future. Just a couple examples. The second type of thesis is bottom up. This is where you pick individual investments that will outperform the overall market. Also, think about what you want from your portfolio. Is it growth? Is it cash flow? Is it preservation of capital, etc.? Determine your risk profile. Look at four things. Number one, are you okay with volatility and ups and downs? Or will downturns make you sell at the bottom, which is the worst thing to do? If you don't mind volatility, use stock-based investing because stocks are more volatile than most other assets. Number two, when do you need the money back? Sooner means more conservative and less volatile investments, so the investment doesn't drop just before you need to sell it. But if it is 10 years out or more, stocks are the way to go since they will outperform most other assets. Number three, are you able to financially weather downturns or not? If yes, you can have volatile assets which will outperform in the long run. If you need the assets to buy groceries, they'll have to be stable, the assets, not the groceries, but won't do well over the long run compared to stocks. And lastly, what return do you need? If you need 5 to 7% per year, your investments can be pretty tame, but if you need double digits, you'll have to buy some risky stuff to try to make that high return. Next, decide on the account type. Do you want a TFSA, an RRSP, non-registered, etc.? If you're at the start of your career and will make more money later, TFSA is probably the way to go at the beginning. If you are in a high tax bracket and making a lot of money, an RRSP will give you tax relief, assuming you are in a lower tax bracket when you pull the money out when you are retired. If you've maxed out either the TFSA or the RRSP, whichever you're using, you can invest through a non-registered account after that. Decide on a portfolio. So look at stocks versus mutual funds versus ETFs and choose the specific investments. I usually recommend starting with ETFs because the fees are lower and they require less research. For beginners, please don't try to pick individual stocks. For most people, ETFs following major indexes are fine. Look at the Canadian Couch Potato website or my TFSA on CanadianMoneyTalk.ca for ETF examples. As an example of my TFSA, I use 4 ETFs for coverage by geography. One following the Toronto Exchange Index, the second following the US S&P 500 Index, the third following EFI, which stands for Europe, Australasia, and Far East, which is developed countries, and then the fourth one is emerging markets, which is developing countries. Choose a discount brokerage that does what you want in the right account for the assets you'll be buying for the least fees. Check annual fees for various accounts, minimum investments for when the annual fees are forgiven, and what no commission ETFs the brokerage supports. Fill out forms, usually online, including checking account info, or send in a paper form with a void check to link the brokerage to your checking account and transfer existing assets, if any. Fill out a pre-authorized payment form for regular withdrawals and possibly purchases to allow automation of the monthly purchases so you keep adding to your portfolio. Transfer money from the checking account to the trading account and buy other assets as desired. You can use a market order to buy frequently traded ETFs at whatever someone is willing to sell for, or to avoid surprises, use limit orders where you specify what you are willing to pay. My monthly TFSA purchases look like this these days in Wealthsimple as an example. Each brokerage will have a different interface, different fees. Some will allow partial shares like Wealthsimple does, and some will allow you to buy automatically without having to press a button. If you don't trust yourself to press the button every month, please automate these purchases. As your portfolio grows, you can expand your portfolio even to include individual stocks, but keep them at a small percentage like 20% of your portfolio once you get past 100,000. Just keep investing every month, reinvest the dividends if you don't need the money today, and one day your future self will thank you. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.